Hello everyone, and welcome to my presentation on automated trading. I put this presentation together because I found automated trading in the FX and CFD markets to be very misunderstood by a lot of new traders. And I've put this presentation together to try and explain some of the pitfalls and some of the things to look out for when you're using automated trading in these markets. So hopefully you get a little bit out of this and a little bit more cautious with what you do with your money. So to start with, I'm going to talk about the differences between semi-automated and fully automated trading. There's quite significant differences there, and there's different approaches you use for both of those. I'll talk a bit about determining the performance of semi-automated strategies, or a bit about how that can't be easily done. And also I'll go through a bunch of sort of common pitfalls of third-party fully automated systems. I know a lot of people sort of put their trust and money into a third-party system, but I'll show you a few things to look out for there. And I'll give you an example of fully automated strategy development, a process which I use, just a bit of an overview to show what's involved with actually developing a fully automated strategy. So to start with, I define there's a distinct difference between semi-automated and fully automated trading. And the big difference is semi-automated has some sort of user or human input into the trades, whereas fully automated is you set it and you run it and you don't touch it. You don't close trades, you don't open trades, you don't decide whether you should take the trade or not. You don't do anything. You just run it until you retire it. And I'll talk about a bit of the difference between the two. So semi-automated trading is you're using an algorithm still. You're following a set of rules and conditions which will notify you of a signal that time to take a trade on this pair in this direction. So you're still following the same algorithm, but the difference is that a human will decide whether they will take the trade or not. After the trade's taken, the user may do other things with the trade, like close it early, adjust targets, adjust stop losses. They've got a bit of freedom to play around with the trade. And despite what people actually believe, the edge from a semi-automated trading system isn't so much in the algorithm itself. It comes from applying a systematic and consistent approach to trading. That's where the main edge comes from. It's not so much from the algorithm itself. Fully automated is different, of course, but in semi-automated, it's giving yourself a better edge by using a systematic, consistent approach. The good thing about semi-automated trading is humans can adapt to the market faster. We don't need as much information as computers do to change the behavior or the way we're doing things. We're very good at that. A computer is not so good at that. A computer needs a lot of data to affect the way it makes its decisions. So you can have more generic sort of algorithms for semi-automated trading because you're adding your human brain to the equation. You can adapt to the market a lot faster. And in my view, the ideal candidates for semi-automated trading strategies are ones that I've tried to develop as fully automated strategies, and they fall short of the performance criteria. So they still look good, they still make money, but not enough to run as a fully automated strategy. Of course, if it is good enough to run as a fully automated strategy, then why should I be using it as a semi-automated strategy? I should just use it as a fully automated strategy. So it's only ones that look good on paper but haven't quite made it to my personal performance criteria. And they're good candidates for semi-automated strategies. But like I said, the main edge is from applying a systematic and consistent approach to trading, not from the algorithm itself. And I'll go into a bit more detail about why that's the case shortly. So fully automated strategies are it requires constant development. So there's not like a holy grail strategy that you can get and run for the rest of your life and make easy money. It's a full-time job. It takes a huge amount of work, and you're constantly developing strategies. You're analyzing these strategies. You're monitoring these strategies, and then you're retiring these strategies when they fall short of their performance criteria. So you usually want about 10 or so strategies running live. Some will be doing well, some won't be doing well, and you're constantly refreshing the ones that are retiring. So it's a full-time job. It's not an easy task. And a really bad misconception of fully automated strategies is that a good back test or past performance will indicate future performance. It's just not the case. A good back test or past historic performance has no indication on future performance. I can't emphasize that enough. Back testing isn't a way to evaluate a strategy. The only way to do it is using a good development process and having a statistically sound evaluation process to determine if the strategy is likely to perform well in the future. Historic data is not sufficient for determining this. Like I said, it takes a huge amount of work. It's a full-time job, but it's enjoyable. If you're really committed to that, then it's quite enjoyable. The other thing is, fully automated strategies, it's very difficult to trust third-party algorithms because it's so easy to make it look good, when in reality you're not going to get that sort of performance in the future. So I personally would never use a third-party system. And people that do may have a bit of a lucky streak and make a little bit of money, but in the end you will lose it. And yeah, in my experience, it's not a very good industry. The people that sell fully automated strategies or rent them out, it's too easy to make it look good when in reality it's not going to perform well. Some of the things to consider when you're thinking about using a semi-automated strategy. So like I said before, the main edge you get from semi-automated trading is sticking to a rigid set of rules, the same strategy or strategies that you use every time. So you get to learn when they might be working well in the market and when they might not be working so well. So that's the biggest edge you get from semi-automated trading. The actual algorithms itself, it's impossible to determine with any statistical confidence that this will be a good strategy or not. And the reason for that is you've got an unknown variable in the equation, which is the human making the decision. This unknown is, you can't quantify that. I've got a little equation here that says the algorithm plus a human is just unknown performance. You don't know if that human will take all the bad trades. You don't know if that human will take all the good trades. You don't know what that human's going to do to this algorithm. It's the same with a basic algebra equation. If you've got the number 10 plus an unknown variable x, there is an infinite number of solutions you can obtain from that equation. So you don't know what the solution will be. Again, you've got your known, you've got your algo, plus the unknown, which is a human. There's an infinite number of results you can get from that. So there's no way to determine whether this algorithm is going to do well for you or not. However, there are some ways you can design a semi-automated strategy to be more likely to do better for you. And one thing is keeping the transaction costs to a minimum in relation to the profit target. For example, if your transaction costs are less than 5% of the target, then it's much more likely you're going to do better with this algorithm, because you only need to build up an edge yourself that is a 5% edge to cover the transaction costs. Whereas if your transaction costs were 20% of your target, then your edge needs to be really something serious to just cover the transaction costs. So ideally, semi-automated strategies are on the daily bars or the 4-hour or 1-hour bars. Anything shorter than that, your transaction costs are going to be getting too high, and the likelihood of you making money on that algorithm is reducing. A good thing to do with semi-automated strategies is think about the fundamentals affecting the markets. Look at the price charts. Look at some other indicators and technical signals, and then decide to take the trade or not with the semi-automated strategy. So think fundamental and trade technical is basically what I say. I think I may have missed a point there. Yeah, so the last point about this is ideal for traders with only sort of 10 to 30 minutes a day to spend on trading, because in 10 minutes, 30 minutes, you can keep up with the economic data, you can have a look at the news, you can have a bit of a skim through what's happening in the global environment, and with that information you can decide whether you want to take a signal or not take a signal from a semi-automated strategy. So if you can't spend 40, 50 hours a week doing fully automated strategy development, all you've got is 10 to 30 minutes a day, then a semi-automated approach would be much better for you. There's much less time commitment in that sense. One thing this is probably the biggest thing with fully automated trading systems. One of the pitfalls of using third-party systems is something called selection bias. Like, there's a lot of bias that you can introduce into a strategy when developing it, and it's very difficult to eliminate all bias, but you can reduce that as much as possible. But selection bias, I'm going to talk about here, which is probably the biggest one when using a third-party system. And one sort of example of how this affects things, I've given here. I've got 4 systems here: System A, System B, System C, and System D. And these are just the profit curves generated from those systems. And System A starts off a bit of a downtrend, and then it goes on and finishes quite well. A 78% return per annum, $8,000 profit in this scenario. System B kind of faffs around in the middle for a bit and then sort of drops down at the end, and you finish with minus $6,000. System C, again, a losing one. It just tanks at the start and just keeps going down, so you lose $12,000 with that system. And System D here is a profit of $12,000. Again, it drops a little bit at the start and shoots up at the end. 89% return per annum. So those numbers sound pretty good. And 89%, 78%. These ones not so good. C and B. So which system would you want to trade? This is you looking at whole 1,000 systems that are available to rent or buy or whatever, and you look at these systems. What one would you choose? And the trick with this example is all those systems were generated with the same algorithm. I just made it randomly placed trades. I randomly placed a trade at random times, randomly closed the trades, just generated a whole bunch of random trades, all using the same random algorithm. And I selected the top 2 results and the worst 2 results, and that's what I put in that previous slide. And that was just out of 20 runs. And the point I'm trying to make here is if you get a whole bunch of strategies, if none of them have any edge, like this random trade system has no edge at all. It's random. It's completely random. So if you selected 1,000 random strategies and looked at the top 10, of course they're going to be good just by pure chance. And that's where you're introducing selection bias into selecting a third-party system. You're just looking at the top 10 of what could be thousands of strategies with absolutely no edge whatsoever. And what then happens is, because they're all just as likely to fail as each other, then you put your real money into that system and it fails and you lose money. So selection bias is going to be introduced. If you're going to look at thousands of trading systems, you're going to pick the best ones, and all you're doing is selecting ones that just by chance happen to have a good historic result. And because you're not developing the system yourself, you have no way of knowing how that system was developed as well. So this is a real thing, and this is the main thing that causes a problem with investing in third-party systems. The future performance is always significantly worse than historic performance. Some of these other things I've seen as well, they've called Pam accounts, where you don't pay for the system, you just invest your money in the system, and if it makes profit, the system developer will take 35% of the profit, or a certain percentage of the profit, and you may think that's a good idea because you think your objectives are aligned, but the reality of this is it's really, really good for the system developers. They can make a lot of money with no risk. Not so good for investors, but if you're a system developer, and I wouldn't do this because I don't want to rip people off, but if you're a system developer, you can get in there, you can offer these Pam accounts, and you will make money when your strategy makes money, and you won't lose any when it loses money. And I've put a little chart here just as an example. This is just a strategy that doesn't particularly, well, it doesn't do very well at all. It's a pretty bad performing strategy. The blue line is the net profit over time. Sort of goes up and down, has some really good peaks and whatnot. And after this time period, which was about 4 years or something, I think it was, you're not far off your break even. So in fact, you were at break even moments, a few weeks before the end of the 4 years. So you would have made about $8,000 at the end. You might, if you finished it here, you wouldn't have made anything. You risked $30,000. So this is the lowest point. You needed $30,000 in your account to survive that period there. So you made $8,000 and you risked $30,000. That's a very bad risk-reward ratio. But look at the system developer, these green shaded areas. They're making 35% profit anytime the system is up. And they're taking that from you. You only get 65 and they're getting 35. So they don't lose any money when it's down, they just make money when it's up. So they've made 50 grand and they've had no risk at all. They didn't lose any money. It doesn't cost them a single thing. So as a system developer, this is great. You just make money with no risk. As an investor, not the best story, because you may actually finish here. You may actually finish at minus 30,000. But these are fairly common accounts. Again, selection bias is a big factor. You're going to pick the best the systems have had the best historic performance, and that has no indication of whether it will have good future performance. You've got no knowledge about how the system was developed. You can actually modify systems to do really well in historic data. If you keep trying and trying and trying and playing with all the parameters, you eventually get one that just randomly does really well in historic data. And if you don't know that wasn't done, then that could be what the case is with the system you're looking at. So if you're looking for that sort of set and forget investment, the FX market and CFDs are high leverage markets are really not the best place for you. Best to stick with conventional sort of well-known managed funds. You might get sort of 10 to 20% return a year. Really reputable funds will do well, and then you can just put your money in, forget it. But and then a couple of years later, you've got sort of 40-50% more money. So that would be a better way to go if you're just looking for a set and forget sort of investment. But not so much for fully automated systems in highly leveraged markets. Again, renting or buying systems, again, they've got all the pitfalls that I've just described. And if you think about it, some of these systems are $50 a month or something, a couple of $100 a month. And you've got these multi-billion-dollar hedge funds that spend tens of millions of dollars on PhD data scientists and financial modelers, and they spend all day, every day, trying to find an edge in the market and developing algorithms to take advantage of that. And it's a lot of hard work. That's a lot of money being spent on experts doing this, and they can make a lot of money. So if they could actually make long-term profits from just renting or buying a strategy online for $50 a month, why would they be spending tens of millions of dollars on experts in the field? It's not logical. Like, if you rent or buy systems, you might be lucky, you might get a short-term profit, might be substantial, you might make 500% in a few months, but in the end you will eventually lose all the money. It's not a long-term strategy to just buy or rent systems. The only way really is to become good at developing your systems yourself. And that's what I do. I develop my own systems. I don't sell them, I don't rent them, I don't let anyone else use them. If they work well, then I just put more of my own money into the system. If they don't make the performance criteria that I set, then I may use them as a semi-automated strategy. But I mean, this is just a couple of things. I'm just going to do a quick overview of what I might do for development of a fully automated system. I start with very limited testing, like a 3-month block on maybe one of the currency pairs to play around with all my parameters, make sure the strategy is working as it should. Have a real play around with it, see how it behaves, and a very small amount of data, sort of 3 months or so. Because once you do this, you've kind of burnt the data. Once you play around with it too much, you then start introducing selection bias and choosing the best parameter set out of the ones you've tested. So you really want to do this playing around on a very limited set of data. I'll test the entries to start with and see. I'll take out trading costs and see if it's got a higher win rate with the entries. Play around again with the parameters and things like that, again on very small amount of data. Once I've got my system working as it should and I got an idea of what range I should be using for my parameters and things like that, I don't optimize the system on the whole set of data. Like 10 years worth of data, I don't just run it on that and choose the best set of parameters. I will run a walk forward optimization, which you can Google walk forward optimization or walk forward analysis or whatever people may call it, and learn about that yourself. But it's a much better way to optimize your system. Things like, again, you can Google Monte Carlo analysis. There are ways to determine sort of statistically what the probability of making money is on the system. You don't want to just rely on one set of results to determine if you're going to make profit in the future. You want to look at a huge number of scenarios that may happen. You need to select what assets you're going to use that algorithm on, and you can't just choose the top 10 assets that happen to perform well on in your testing. You need to have methods of determining what's the best basket of assets to use. This can be a quite complicated process, and there are different ways you can do that, which again, I'm just going through an overview here. I like to do things like testing the performance of the timing of the entry, not necessarily the direction, but is that a good time to enter the market? And I do some sort of randomization simulations and things like that to really test the timing of that signal, whether that has any real edge. And then I test the direction performance, so whether the algorithm is actually choosing a good direction to go in. If it's saying go long, is that the direction it should be going? And again, a lot of randomized simulations to work out a bunch of scenarios to see if my algorithm actually, performs in the top sort of 2% of those randomized simulations. I'll look at my exit separately as well, see if the exit, you might have a good entry but a bad exit, or a good exit and a bad entry, so you can evaluate that separately, maybe mix and match them with other trading ideas. And then after I'm sort of happy with the results, and it's very difficult to get your algorithm all the way through to this stage I call incubation. A lot of them fail, and you don't want to keep playing with your algorithm until it comes good. If it doesn't work, then get rid of it, start a new trading idea. The more you play around with it, the more likely you're going to introduce selection bias and be trading something that's not likely to make money in the future. So incubation, I just like to run the algorithm on micro lots, basically the smallest trade size you can do, for a couple of months, few months, and I want to see how it behaves in the live market. And I might notice a few things that aren't going as they should, so I might have to play around with that and fix those things up. But it's basically just to see if it's behaving at the way it should, the way you anticipate it before you scale it up and go to live trading. I didn't put the point in there about sizing or scaling the system as well, but there are methods for determining the best way to size the trades and to scale the system, but I won't go into that now. And then obviously live trading, but it's not you just put it live and you forget about it. You're going to make money from that for decades to come. It's these algorithms will be, might only last 3 months or 6 months or a year or maybe a couple of years if you're lucky. So you need to be constantly monitoring the performance of these algorithms, and you need to have like an exit conditions, like when will I stop using this strategy, and you can set up your own performance metrics for what you want to be looking for, but you need to have a way to say, I will stop this strategy when these metrics are equal to this, and that's when you retire the algorithm, and hopefully you've got another one ready to go to replace it with. So like I said before, if you've got about 10 or so algorithms running, and you're constantly retiring the ones that have lost their edge and replacing them with newer ones, then you should get long-term consistent profits from your algorithms. And like I said, that takes a lot of time. So I will just mention at the end of this little clip is I do have an automated trading platform called Quant. It's a semi-automated trading platform that I basically built for myself, and I just let other people use it. It's a free platform. You just need to download the EAs for MT4, so you download them and run them through MT4, and it connects to a web platform, which makes it just really easy to set up strategies, see signals when they appear, look at data. It monitors the performance of your individual strategy, so if you're running a few strategies, you can see which ones are working and which ones aren't. There's videos on my website, www.quantblack.com, on how the system actually works and how you can use it, but it's free. I'm not asking any money for this. It's what I use to do my trading, and I do better on a monthly return basis using semi-automated trading compared to my fully automated trading system. So this is where I make most of my money on this platform that I built. So yeah, feel free to check it out and have a look at it. All right, thanks for your time, and hopefully you all got something out of this.